Hey everyone. So if you're a founder or an employee with stock options or even an early investor in a startup, you've got equity. But let me ask you this. Do you have any idea what that equity is actually worth if the company sells? Today, we are going to pull back the curtain on one of the most critical and honestly most confusing concepts in the startup world, liquidation preferences. All right, let's get into it.
So let's just cut right to the chase. Imagine this. Your startup, the thing you've poured your blood, sweat, and tears into, gets acquired for $10 million. Not bad, right? And let's say you own 30% of the company. So, simple math. You walk away with $3 million, right? Well, you might want to hold on because the reality can be, and often is, wildly different.
And here's why. That simple ownership percentage you see on your cap table, it doesn't tell the whole story. Not even close. The real answer, the one that determines how much cash actually hits your bank account, is buried in the fine print of those investment deals, in a set of rules called liquidation preferences. These rules basically dictate the entire pecking order for payouts.
So, what exactly are they? Well, in plain English, liquidation preferences are rules in a contract that give preferred shareholders, that's your investors, the right to get their money back first when the company is sold. You can think of it like this. They get to skip to the front of the line to get paid before common shareholders, the founders and employees, see a single dime.
Okay, so to really get how this all works, we need to kind of break down the rule book. We're going to walk through the most important terms you'll see, the ones that decide who gets what slice of the final pie.
All right, so this is the first and maybe the biggest fork in the road. It's the difference between non-participating and participating preferences. Non-participating is basically an either-or deal. An investor gets to choose one of two things. They can either take their original investment back, or they can convert to common stock and take their percentage of the sale price. They'll just pick whichever one is bigger. But participating, that is the infamous double dip. With this, investors get their money back first, and then they also get to take their ownership percentage of whatever cash is left over.
And here's what that actually looks like in practice. Remember that $10 million exit? Well, with a non-participating deal, the investor might just take their $3 million investment back. But with participating preferred, they get their $3 million back plus their slice of the leftover $7 million. Suddenly, they're walking away with over $5 million. That's a $2.1 million difference, and guess where that money comes from? Straight out of the pockets of founders and employees.
Okay, so that double dip sounds pretty scary, right? Well, here's the good news. The market has overwhelmingly shifted to be more founder-friendly on this. Data from 2024 shows that a whopping 97% of deals have a simple 1x non-participating structure. That just means investors get their initial investment back, and that's it. That aggressive double dipping, thankfully, it's become pretty rare.
So let's build on that. What happens when you've raised money more than once? You've got Series A investors, Series B. This is where you run into pari passu versus stacked preferences. Pari passu is Latin for on equal footing, and it's exactly what it sounds like, all in together. All the investors are treated the same, and they share the money proportionally if there isn't enough to pay everyone back. Stacked, though, that creates a VIP line. The newest investors, say your Series B guys, get paid back in full before the earlier Series A investors see a penny.
And you can't overstate how high the stakes are here. As Christopher Warren at Overcarta puts it, these kinds of terms like stacked preferences or high multiples, they're designed to protect investors if things don't go perfectly. But, and this is the key part, that protection always comes at a direct cost to other equity holders. In other words, you. Okay, so we've got the rules down, but how do you actually use them to figure out who gets paid what? Well, the tool everyone uses for this is called a waterfall model. It's basically a spreadsheet that maps out exactly how the money flows, step by step, from the sale price all the way down to every single shareholder.
Now, building one sounds really complicated, but it actually boils down to 4 pretty logical steps. First, you figure out the exact amount each investor is owed based on their preference. Second, you do a quick check. Would they make more money if they just converted to common stock? Third, you apply those seniority rules. Are we all in together, or is there a VIP line? And finally, you distribute whatever is left over. That's it.
All right, now for the really fun part. Let's actually use this model to run a couple of simulations. We're going to see just how dramatically these rules can change the outcome in a couple of different real-world scenarios.
So, first up, a more modest exit. Let's say the company raised $5 million from its Series A investors, but it only ends up selling for $8 million. This is exactly the kind of situation where those preference terms become incredibly powerful.
Just look at this.
With a standard 1x multiple, the investors get their $5 million back and the founders pocket the remaining $3 million. Not a home run, but hey, it's something. But what if those investors had negotiated for a 2x multiple? Well, their preference is now $10 million, which is more than the sale price. So they take the entire $8 million, and the founders, who built the company from nothing, walk away with zero. A complete wipeout. The difference is absolutely devastating.
Okay, now let's flip the script completely. What happens in a much bigger, more successful exit? This time, the company crushes it and sells for $30 million.
Now, here's where things get really interesting and a little counterintuitive. In a huge win like this, that 2x multiple we were so worried about, it becomes totally irrelevant. Why? Because the math changes. The investor's simple ownership percentage of that $30 million sale is now worth way more than just getting their money back, even 2 times over. So what do? They convert to common stock, just like the founders. And the final payout ends up being exactly the same whether they had a 1x or a 2x multiple. It's a crucial thing to understand. Those multiples are downside protection for investors, not a way for them to get richer on the upside.
Okay, so knowing the rules and seeing how they play out is one thing. But how do you actually make sure your cap table is set up for success and that you avoid these costly, heartbreaking mistakes? Let's get into our final section on best practices.
These right here are the landmines you have got to watch out for. Misunderstanding participation caps, which are basically limits on that double dip. Ignoring anti-dilution provisions, which protect investors if you have a down round. Getting the stacking order wrong, that VIP line we talked about. Or just forgetting to check if converting to common makes more sense. Any one of these can throw your entire waterfall calculation off by millions.
So how do you avoid all that? You treat your cap table like the critical business document it is. Review it every quarter to catch mistakes early. Keep a super careful record of things like convertible notes and safes so there are no surprises later. Use version control so you have a perfect history of every change. And most important of all, have your lawyer review it on a regular basis. You have to make sure the math in your spreadsheet perfectly matches the legal reality of your term sheets.
So if there's one thing you take away from all this, it's this. You need to completely reframe how you think about your cap table. It is not just the boring spreadsheet that lists who owns what. It is a dynamic, predictive model. It can literally tell you the financial outcome of your life's work under almost any scenario. Which really just brings us to our final question. Now that you understand the rules of the game, now that you see just how high the stakes are, you have to ask yourself, is your cap table, your predictive model for the future, actually built for the outcome you want? Is it built to win?